May 13th, the April 2025 CPI release. It really feels like the whole financial world might just be holding its breath for this one.
It really does, yeah. A lot is riding on these numbers.
And that's exactly what we're doing in this deep dive, right? Our mission is, well, pretty focused. Figure out how this CPI data could actually shift things for your investments. We're digging into some professional analysis, a pre-release forecast too, trying to get a handle on the potential ripples. You know, everything from the US dollar's value, maybe even Bitcoin.
Absolutely. We want to go beyond just the headline number, pinpoint what really matters in the report this time.
Okay.
So we'll look at the kind of the economic backdrop right now, zero in on the crucial bits within the CPI data, and then sketch out maybe 3 different ways the markets could react, depending on what we see.
Okay, let's get into it. Quick reminder for everyone, CPI Consumer Price Index. Basically, it tracks how prices are changing for, everyday stuff.
Groceries, gas, rent. Yeah, exactly. Stuff we all buy. And this report, it's key because, well, we're trying to answer some big questions like, is disinflation that slowing down of price increases, is it still happening?
Still on track, yeah.
And how's this going to hit the Fed? They're thinking on interest rates.
$1 million question, always.
And maybe, are we going to see any early hints from those new 10% tariffs on Chinese imports? Is that going to show up yet?
Those are definitely the core questions, and the analysis we looked at, it really flags some specific areas in the CPI report itself as being, well, extra important this time.
Like what? What should we be watching?
Okay, first step, core services excluding housing. So think like medical care, transportation costs, that sort of thing.
Okay. Why those specifically?
Well, they're interesting because they aren't tied quite as much to, say, global supply chains. They're linked more directly to wages, to what's happening right here at home.
Domestic pressures.
Exactly. So they can be a really good signal of how stubborn, how sticky that underlying inflation might be. Prices that don't jump around like energy does.
Right, that makes sense. So those are the services really driven by what's happening, here at home.
Precisely.
Okay, and then there's housing. That's a huge piece of the CPI, isn't it?
Oh, absolutely. Massive. Both rent, actual rent people pay.
Right.
And this slightly trickier one called owner's equivalent rent, or OER.
OER. Yeah, I've seen that.
Yeah.
What exactly is that, and why bother including it?
Yeah, OER. It's an estimate, really. It tries to figure out what homeowners would be paying in rent if they were renting their own home.
Oh, okay. Hypothetical rent.
Kind of, yeah. And they include it because, well, housing is just such a big expense for almost everyone, whether you rent or own. It tries to capture that ongoing cost of shelter across the board.
Got it. And obviously energy prices, too. We know those can swing the numbers around a lot.
Definitely need to watch energy. It's been helping cool things down lately.
And food. Our sources mentioned splitting out groceries versus eating out.
Yeah, that's a useful distinction. Restaurant prices often reflect labor costs more, while groceries might be more commodity-driven.
Okay.
And one more specific thing within those core components, medical services. Keep an eye on those prices.
Why medical in particular?
Because those numbers feed quite directly into the Fed's preferred inflation gauge, the Personal Consumption Expenditures Index, the PCE.
Ah, right. The PCE.
Yeah, the Fed tends to lean on the PCE. It covers a slightly different basket of goods, weighted differently. Some argue it's maybe a broader picture of inflation.
Okay.
So what happens with medical costs in the CPI gives us a bit of an early clue about where the PCE might be headed.
Got it. So that's what's inside the report. But let's zoom out. What's the bigger economic picture right now? What's the context for this release?
Good question. So the backdrop is, well, the U.S. has been seeing this gradual disinflation. Prices are still going up, but not as fast as they were. That's pretty clear from the official data.
Okay.
And headline inflation, the number that includes everything, food and energy, that's been easing off. Mostly thanks to, like we said, lower energy prices and housing costs not rising quite so quickly.
But still too high for the Fed.
Oh, yeah. Still above their target, definitely.
And what about core inflation? The stickier stuff? Taking out food and energy?
That's been cooling too, but slower, more gradually. It seems those labor-intensive services, think haircuts, personal care, things like that, prices there are still, pretty elevated.
So even if the main number looks okay, it's those underlying service prices that might keep the Fed worried.
That's a really key point, yeah. No, the labor market, it's giving off some mixed signals, which is interesting.
How so?
Well, March, we saw pretty strong job growth, right? 228,000 jobs added. Still looks healthy, but Unemployment ticked up just a little bit. Now, that could suggest things are maybe starting to cool off slightly.
Which might ease wage pressures.
Exactly. If the job market isn't quite so tight, maybe wages don't rise as fast, which, takes some pressure off inflation. And that's the theory anyway.
Okay. And what about what businesses are paying? Producer prices.
Those have been moderating too, which is good news. It means less cost pressure building up before it gets to consumers.
Right. Less fuel for future price hikes down the line.
Precisely. And remember, the PCE, the Fed's preferred gauge, it was actually stable month over month back in March. Flat.
Okay, so that reinforces the disinflation idea.
It does. But despite all these, let's say, encouraging signs, the Fed's been pretty cautious, right? Keeping rates steady.
Yeah, holding tight.
And you mentioned the tariffs. Fed Chair Powell has actually mentioned concerns about tariff risks recently, so that's definitely on their radar.
Okay, so let's talk tariffs. That new 10% on certain Chinese goods, how much impact will we see in this April report?
Well, interestingly, the analysis we looked at suggests maybe not much. Not yet, anyway.
Why not?
Couple of reasons, potentially. First, there might be exemptions for stuff that was already on a ship, before the tariffs kicked in.
Goods in transit.
Right. And second, this idea of consumer front-running.
Front-running. You mean like people rushing out to buy stuff before the price went up?
Exactly. If you thought, say, electronics or clothes were about to get more expensive because of tariffs, maybe you bought them in March instead of waiting.
Huh. So that could have pulled some demand forward.
Could have. So because of those things, the thinking is the real price impact from tariffs might only start showing up more clearly in, say, the summer data releases. May, June, July.
Okay, that makes sense. The impact might be lagged. All right, so we have the context, the things to watch inside the report, the tariff situation. Let's get to the scenarios. The analysis laid out 3 possibilities based on the forecast. What's scenario 1? CPI comes in hotter than expected. Above forecast. They give that a 25% chance.
Right, the above forecast scenario. If that happens, uh-oh. It basically suggests that disinflation might be hitting a wall, maybe stalling out.
And what would cause that?
Could be those sticky service prices just refusing to cool down. Or maybe, just maybe, some early tariff effects are bleeding through on things like, I don't know, apparel or something.
Okay. And the Fed's reaction?
They'd likely stay very cautious, very hawkish maybe. Forget about rate cuts anytime soon. They'd want to see much more proof that core inflation is really heading down.
Makes sense. And markets? How would they take hotter inflation?
Well, probably. You could see the U.S. dollar strengthen, right? As hopes for Fed cuts fade. So, against the euro, the pound, dollar up.
Okay.
Stocks, S&P 500 could dip. Tech stocks might get hit harder. Higher rates aren't great for growth valuations. Maybe defensive sectors hold up a bit better.
What about commodities? Gold, oil.
Gold might soften. Higher rates make bonds look more attractive than gold, which pays no interest. Copper maybe weakens on growth worries. Crude oil?
Yeah.
Probably more driven by supply stuff, so maybe more stable. Hard to say for sure.
And crypto?
Yeah, Bitcoin, Ethereum could see a pullback. Higher inflation, higher rates usually mean less appetite for riskier assets. So, risk-off move.
Okay, that's a clear picture for the hotter scenario.
Yep.
Now, the middle ground. Scenario 2. CPI comes in pretty much as expected, right on forecast. The analysis puts us at 50% probability, the most likely.
Yeah, the at forecast scenario.
Yeah.
If this happens, it's kind of a confirmation. Confirmation that, yes, disinflation is still happening, just gradually.
Steady as she goes.
Pretty much. You likely see that balance we talked about, housing and energy cooling things off a bit, but services still showing some pressure.
And the Fed's response.
Probably maintain the status quo. Keep watching the data. No big policy shifts, likely based on just one inline report. Just keep waiting and seeing.
Okay. And market reaction to inline.
Likely pretty muted overall. Currencies like Eurodollar, Pound Dollar probably stay fairly stable.
No big swings.
Probably not. S&P 500, maybe some shuffling between sectors as people digest the details, but the main index might not move dramatically. Kind of neutral.
Gold, oil, Bitcoin.
Yeah, gold probably steady. Oil, likely not much change. Bitcoin might just keep trading sideways, within its recent range. No big catalyst either way from an as-expected number.
Okay, makes sense. That leaves the third possibility. Scenario 3. CPI comes in below the forecast, softer than expected, also given a 25% chance. What would that imply?
a below forecast print. Now, that would be interesting. It would suggest the Fed's tight policy, those high rates, are maybe working even better than people thought, really biting into inflation.
What could drive a softer number?
Could be housing costs cooling faster than expected, maybe energy prices drop more, or maybe it reflects weaker demand after that potential front-running we discussed back in March. People already bought their stuff.
Ah, right. So demand eases off in April.
Possibly. And if you get a soft CPI number, especially if upcoming job numbers also look weaker, then talk of Fed rate cuts would definitely heat up.
Okay. Increased chance of cuts and the market reaction.
Probably the opposite of the hot scenario. You'd likely see the US dollar weaken as rate cut expectations rise. So euro and pound could gain against the dollar.
Guys.
S&P 500 could rally. Tech stocks, real estate sectors that like lower rates, they might lead the way up.
And commodities.
Gold could climb. Lower rates make gold relatively more attractive. Copper might gain too, maybe signaling more optimism about growth if rates are coming down. Oil maybe gets a slight bid from that general risk-on mood.
And Bitcoin. The risk assets.
Yeah, Bitcoin could potentially surge. Lower rates, more liquidity, increased risk appetite. That's usually a good recipe for crypto.
Wow. Okay.
Yeah.
It's a really helpful layout of the three potential paths here. And it's good you mentioned the source analysis had a glossary too, defining things like disinflation, sticky prices. Hopefully our chat helped clear those up too.
Hope so.
So wrapping this up, what's the main thing you, the listener, should take away from all this?
I think the crucial point is just how pivotal this May 13th CPI release is. It's not just another number. It really could sway Fed thinking and, consequently, move markets pretty significantly. Forex, stocks, the works.
And pay close attention to.
Definitely watch those core services, excluding housing trends. And keep an eye on the housing cost numbers themselves. Those are really key pills right now.
Okay. And looking ahead, what else should we watch?
Well, we get the Producer Price Index, the PPI just before the CPI on May 11th. That gives clues about pipeline pressures. And of course, listen carefully to any speeches from Fed officials in the coming weeks. Their commentary is always important.
Absolutely. So maybe a final thought for you listening. How might this CPI data, whichever way it lands, influence how you see the markets and what the Fed might do next? Worth considering.
Definitely.
Definitely follow the release on May 13th. We'll certainly be watching. And we look forward to diving into the actual results and what they mean right after. Thanks for tuning in to the Deep Dive.
Thanks, everyone.
Stay curious, keep exploring, and we'll catch you next time.